Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elkanan, along with Brianna Valesky, and we have Joe Childrey on the line. He's Managing Partner and Chief Investment Officer of the Probabilities Fund. Joe, how you doing this morning?
Doing great from San Diego.
Oh, we called you kind of early. Well, thanks for joining us at this early time. Could you give us a little bit of your background and how you ended up launching and managing the Probabilities Fund?
Sure. Well, I was always interested in investing and joined PaineWebber as an investment advisor, and then had the good fortune of being at A.G. Edwards for 10 years, and then 5 years at Wells Fargo, managing personal money and institutional money. And I was on my way to Africa, believe it or not, for a 2-week trip, and on my desk was the Stock Trader's Almanac, which is a Wiley publication, and I highly recommend it for your listeners.
Oh yeah, we have Mr. Hirsch on quite a few times. It's a great publication.
That's right. Well, Mr. Hirsch is on my investment committee.
Ooh,
and
okay.
Basically, what happened is I had left my reading material at home and was late for my flight. All I had was the Stock Trader's Almanac, which I proudly displayed on my desk year after year and never really got into it. So for 2 weeks, I had the Stock Trader's Almanac as my only book, and I made the best of it. And I came back basically a pattern recognition guy, trend follower, and I tried to put the information that I learned in the Stock Trader's Almanac and on the internet. I mean, basically seasonal investing, trend following, pattern recognition. Academic people have been studying these trends and patterns for frequency and magnitude for years. And as you know, from listening to your show, people come out and talk about sell in May, go away, these interesting patterns. And for us, really, we look at the big deal is how to turn that information into knowledge, how to turn that knowledge into wisdom and make it work for your portfolio. And that's what we do at the Probabilities Fund. We take most of the information that's out there, and we look at it for cause and effect. We look at it for correlation, and the result is we have a mutual fund. And as you might know, we started out as a hedge fund the first 6 years, charged very high fees, had lockups. Then through demand, really, we merged the hedge fund into a publicly traded no-load mutual fund. Symbol's PROTX. You can go to Morningstar.com and enter the symbol, and you'll see the performances from January 1st, 2008 to present. And we basically are in or out of the market, leveraged or short. And our clients are generally in cash about 30% of the time.
Wow.
Mm-hmm.
Also, you're an inventor, and you have in the consumer electronics industry, and you have a product that's marketed and sold worldwide. What is that product?
That's right. Well, it's a wireless remote control wall bracket for flat screen TVs. So imagine you're in your favorite love seat, and then you move over to the kitchen, and you just can press a button. It used to be we had a proprietary remote. Now you can use your phone, and I'm a pilot, so you could say tilt and swivel, but I like to say pitch and yaw, and you can adjust your TV to the tilt and swivel to your viewing pleasure, and that's you just use the up arrows and the sideways arrows on your remote or your iPhone now. So it's kind of a neat product. Unfortunately, it's a high-end product, and these days the remote control wireless wall bracket is more expensive than TV.
Okay. All right, let's go back to your fund here. And you made an interesting
Sure.
comment. You said that you're either what were the three things? You were either leveraged.
Well, we're in or out of the
Okay.
S&P 500. We're either in or out, leveraged or short, depending on the situation, depending on the trend and pattern that we recognize, particularly seasonal and political.
And so, what are you now here in April 14th? Had a tax season here coming into earnings season. How you guys sitting today?
Well, today we're 1x or beta, so our proxy is the S&P 500. We've been able to beat the S&P 500 by a wide margin, and we've done that even by being in cash 30% of the time. So today we're 1x, and your listeners might know from speaking with Jeff, listening to Jeff on your show. We use a moving average to help us get in or out a little earlier or later than some of our rules-based trades. And so we're waiting for the moving average to converge, where a long-term moving average converges with a short-term moving average. And our next directional trade will be to go to cash and protect principal.
You sound like you're not in too many instruments at all. What do you use? Like the spiders, the S&P futures? What's your preferred choice of an investment vehicle for your fund?
Good question. So we're technically a fund of funds. We trade the ETFs, primarily the Vanguard S&P 500, the Spider, the direction leveraged S&P 500. We're sort of a people, philosophy, process shop. Our people, my original partner's name is Alan Shepard. Alan's a math PhD, and yes, his uncle is the astronaut. And John Chatfield and Rob Osdale, two CFAs on staff, and then our newest member of the investment committee is Jeff Hirsch of Stock Traders Almanac, and we're just so happy to have Jeff on the team. We didn't realize the incredible research capability his shop brings to the table. So we look at things like sell in May, go away. We look at turn of the month, quarterly window dressing. We look at pre-election years versus election years, whether Congress is in session or out of session. We put all this information in the computer and figure out when to be in, when to be out, and that has really served our clients well. So the people, we think we have a deep research capability by our staff, and our philosophy is pretty simple but not easy, and that is to be out of the market when there's a higher probability of risk or downside, and then in the market when there's a higher probability of upside reward. And again, we're doing that by looking and trying to learn from history and these deep patterns and trends that are out there.
When's the last time you were out of the market? When was the last time you were out of the market?
We're out of the market quite a bit. In any given day, a signal, we have what we call rules and signals. The rules are based on the seasonal patterns that we talked about, presidential cycles, and the signals are more event-driven, which are daily. So we actually are in cash throughout the month. And
okay.
Because our process is a fund of funds, we have great liquidity. The fund right now we're managed about $120 million. This could easily be a multi-billion-dollar fund because we're trading the S&P 500 primarily.
Another question for you here. I mean, you started your fund in 2008, correct? And when in 2008 did you start it?
January 1st, 2008.
I mean, Mr. Market's been pretty helpful to you. How do you think that, you think you're going to be able to maintain these, these kind of performances if we go into an extended bear market?
We think so. In fact, the fund, because we started January 1st, 2008, we're pretty known for our 2008 performance, where we had an up year. We were up over 5% in 2008, and the S&P was down 37% during the same period. We've never had a down year. And then in 2011, when the S&P was flat and over 90% of U.S. equity mutual funds were down, Probabilities Fund was up double-digit. So really, the tough markets are where we shine. We have about a 0.4 correlation to the S&P. Even though we're trading the S&P, we have a very low correlation. Goldman Sachs wrote a great white paper in 2011 called The Fashion Faux Pas of Equity Investing. And what they concluded is that something you and I know, and many of your listeners, it's just very tough to find a non-correlating equity asset class these days, whereas in the old days, in the 90s, for instance, you could diversify by growth or value, U.S. or international, small, mid, large cap, and truly find a non-correlating asset class. There's outliers these days, but primarily when the market's up, all stocks are up, all indices are up, and when they're down, they're down. So the challenge for investors today is not to find, try to figure out if passive is better than active or something like that. That's the big debate in Wall Street. Who's cheaper, things like that. What we found is, it doesn't really matter to us if the advisor or the client is passive or active. The way we look at it is, are you long only or tactical? If you're long only, and many times a lot of our clients will have a long only bias, and they'll put together a traditional stock, bond, cash portfolio, and to us we don't care whether the stocks are in index funds or if they're a mix of U.S. international or active funds. What we want to do is carve out a part of that to be in there in case the bear market comes, which it always does, and it will. And we haven't reached a point where the cab driver is given stock tips, things like that. But as you mentioned, this is a extended bull market, arguably the second longest, and the typically, if you go back in history over 100 years, these don't fight the Fed, jobless recoveries end badly. So we want to be prepared and be part of the portfolio that adds value when that happens, and we are prepared for that.
And you go short ETFs, you use the futures, short the spiders. How do you go short the market?
Another good question, and we are a long short U.S. equity fund, but the way we trade is we trade inverse ETFs.
Okay.
So that allows us to be long, but when the market declines, our clients make money when we're short.
Okay,
so we're all ETF. We're either ETF or cash, and the key is to learn from history. It doesn't repeat itself, but often it rhymes. And so we look at things like, for instance, you may not have heard when one of our signals is the Congressional Effect. We've learned that when Congress is in session, when the House and Senate are in session, now this strategy only goes back to 1965. A lot of our stuff goes back to the 1800s. But since 1965, a good 50 years, when Congress is in session, the market has increased around 1% per year. When Congress is out of session on vacation, it's compounded at 16.5% per year. So that's one of the signals that we look at that is a daily signal. It's really fascinating how many of these rules and signals that you can find out there. And a lot of times advisors and individual investors, not the hedge fund managers, will bring some of these things to our attention, like a pre-Fed announcement drift, where the market generally increases the day before the Fed announcement. And we found it doesn't matter what the Fed says, the market increases. So that's a real short version of what we do, but really good questions, and I think the listeners get an idea that we're not long only, and we're going to go to cash to protect principal during those periods of high risk.
Joe Childrey, Managing Partner and Chief Investment Officer of the Probabilities Fund, joining us here on Benzinga's Pre-Market Prep. Thanks a lot, Joe. Have a great trading day. We hope to speak to you again soon.
Look forward to it. Have a good day.